Welcome everyone to the 911 real estate call. Whether you're a doctor, managing patients,
business owner, running operations, or an entrepreneur balancing multiple ventures, this space is designed for you.
multifamily real estate investing can seem overwhelming,
But today, we're here to make it simple and easy to understand. Together, we'll dive into real deals, discuss strategies, and exchange ideas to help you grow your portfolio and generate true wealth.
This call isn't just about properties, it's about building strong connections and creating long-term financial success.
Let's jump in and unlock the next step in your investment journey.
Okay, well, welcome everybody. We're kicking off this call. Welcome to the 911 Real Estate Show. Today we have a really special guest. We have the privilege of introducing a powerhouse in real estate investments. His name is Paul Stanton. Paul's a strategic mind in commercial real estate, capital markets, and investment banking. As a co-founder of PTB, a boutique investment bank, he has helped structure deals and raise capital for projects at over $20 billion. That's with the B, right? He's also served as a head of strategy at Equilium, which drives innovation across 60 million square feet commercial space worldwide. His expertise spans from acquisitions and asset management to pioneering investment strategies that gives investors direct access to alternative real estate markets that are still under institutional radar. Now, Paul's also an educator. He's a thought leader. He runs Thesis Driven, where he teaches investors how to structure deals and invest like an institutional LP. His insights bridge the gap between capital and opportunity, making complex real estate investment strategies simple and actionable. So without further ado, Paul, you take over, my friend. The stage is yours.
Thank you, Alex. Such a nice intro, and appreciate it. I could never you put me in a better light than I'd ever put myself, but I appreciate that. So nice to see everybody on this. Thanks for taking the time this morning. You know, the real goal of this class today is really focused on institutional capital raising. So if we walk away with one thing, I hope folks will recognize kind of the ecosystem of institutional investors and really understand that it is a very formulaic industry or investor type for raising capital. As many of you have probably been through the process of raising money from high net worths and friends and family into individual syndicates. In many ways, institutional investing is easier in the sense that there's very much a formula into how to get in front of institutional investors. Their day job is looking for real estate deals. So, once you have the right formula for getting in front of them, it's not necessarily that hard. Structuring deals with them is hard. And ultimately getting them comfortable with your track record and things like that are much harder. But, the formula for actually, approaching these folks is, relatively straightforward. So, that's a lot of what we're going to spend time on today. As Alex said, I run a boutique investment bank with a partner called PTB, and we raise institutional money for real estate deals. So this is my day job. And then I also have, with another partner, Thesis Driven, which we have an education platform, really because we see, on the capital market side, we teach a lot of things, but capital markets, we really see a huge gap there's so many smart people doing really innovative things in real estate, but there is no education platform out there to really understand, the ecosystem of the real estate capital markets and how to access it. So that is a separate part of, my day job now. But this is, a lot of this is pulled from our capital raising courses, a small part of it. But, again, kind of going to dive into, who these investors are, how they think, what they're looking for in deals, deal size, check size, et cetera, et cetera. So, as discussed, I'll kind of go through this in the first half hour and then look forward to rapid fire Q&A throughout. So anyway, without further ado, just two things I want to touch on, just to make sure that we're all clear. And again, I think, there's a relatively sophisticated group here on the call today. But one metric that we're going to talk a lot about when it comes to institutional investors is unlevered yield on cost. And, hopefully many of you are familiar with this metric. But, typically when you're talking to more retail investors, they're looking for IRR, right? They're looking at annual returns and they're saying, what is this, if I'm going to write a 50 or 100 or $250,000 check, I'm looking at a return in real estate versus a return in, a tequila company or, investing in some ETF or something like that. When you're talking to institutional investors, the reason unlevered yield is so important is because it's a metric that's focused before leverage, before we put debt on a property. So it really explains the efficiency of a real estate deal. So, the simple metric is your net operating income. So, how much revenue are you generating off of the property minus the operating expenses to get your NOI over the total cost of the project. So, the total cost is what does it cost to buy the land or buy the existing building? Then what does it cost to develop that land or, redevelop that existing building? And so, the higher the unlevered yield, the more efficient that investment is. And for institutional investors who are looking at, all different types of real estate investment opportunities, they know how creative they can get with leverage and all different, financial engineering structures to make the equity returns more attractive. So they're experts in that. That's what they're really good at. Unlevered yield is that raw material that they get, that they're like, all right, how efficient is like the raw material that I'm working with so that I can get really creative with how I finance this stuff. So, that's what we're really focused on, when we're pitching to institutional investors is that unlevered yield. So, and that may be counterintuitive, but, they don't want us to necessarily assume, again, how to get creative with leverage to kind of juice the IRR. They just want us to give them the raw material. So that's why, we will talk a bit about unlevered yield. And just to comment on that, in today's market, it used to be unlevered yield is something that we typically think about in relation to where interest rates are today. So, when we are talking to institutional investors, the way they're going to be thinking about this is, can I get positive leverage? So if I have an unlevered yield that is, if I'm underwriting something to like an 8% unlevered yield, and I know the debt I can get is at 6.5%, that 150 basis point spread is, represents positive leverage. That's a good thing. That means it's something that I can probably, juice up with debt. And, conversely, if, I'm underwriting to an unlevered yield of, 4 or 5%, or if I'm just buying something that's a cap rate, it's very similar to cap rate. If I'm buying something that's at a cap rate of 4 to 5%, and my debt is 6.5%, now there's a negative spread. And so for institutions, they're not going to be able to, invest in something like that because, again, they rely heavily on leverage to invest in projects. So, that's why you've seen, just as one quick example, billions and billions of dollars that's sitting on the sidelines right now within institutional investors trying to invest in single family homes, but they just can't. Back in 2020, 2021, when interest rates were at 2%, if they could buy at a 4 cap, or the unlevered yield on the project that they were looking at was 4.5%, there was plenty of positive leverage that could be applied there. So that's really one example of many as to why institutional capital is sitting on the sidelines right now and isn't investing in many asset classes, because it's just very hard for them to find anything where they can get positive leverage. So, it's just a quick note on unlevered yield. And the other metric, of course, that's still important is IRR. We're not going to break down IRR here, but IRR is your annual return that you're getting on your equity, and that takes into account leverage. So institutional investors are still going to care about IRR, but unlevered yield is going to be, the primary metric that we're going to be using to talk about the efficiency of our real estate deals.
Can I just ask a question of clarification? Because
of course, Lauren.
You had the unlevered yield, because I'd asked you this before, but I think other people may have the same question. But you're saying that you want the unlevered yield to be that after the business plan has been executed, right? That the target of 9% would be after business plan execution.
That's a great question. And it's also a good way to clarify the difference between cap rate and unlevered yield, because cap rate is something you buy. So if you're buying an existing building, let's say you're buying a multifamily asset that you're not really doing anything to, it's already cash flowing. And maybe, you'd say you're buying that in an 8 cap, which means, your NOI is, call it $80,000 and you're buying something for, you know, $1 million, the asset. And so you're buying something in an 8 cap. Unlevered yield means, you know, kind of after the business plan has been executed, like what is the cap rate? But yes, when we're talking about unlevered yield, we're talking about not what we're buying it at, but once we execute our business plan, we've stabilized it, we've hit the you know, the rental metrics that we hope to hit, and the stabilization metrics that we hope to hit, and then that's the snapshot of our unlevered yield. Thanks for clarifying that, Lauren. So now I want to get into, you know, the investor landscape here. So when we're talking about institutional investors, you know, all of you, and I'm just going to talk about all investors generally, you know, you're all probably familiar with, you know, high net worth individuals who, you know, are infinitely flexible. They're individuals. They can, you know, write any size check depending on their net worth. And they typically invest into, you know, commingled structures, i.e. they're not in control. They're just passive LPs. So, you know, in so many ways, the best type of investor you want to be working with. But obviously, you know, as projects get bigger and bigger and bigger, you get to a point where it's just too hard to corral so many, you know, smaller LPs. So, you know, that's why we start to look towards institutional investors, because institutional investors can write. I mean, you know, the challenge with institutional investors is they have to write larger checks. So, you know, it's again something that's kind of counterintuitive, but you want to be going to them with asking for more money, not less. So it's a lot easier to ask for $100 million than it is to ask for $50 million. And it's even easier to ask for $200 million than it is for 100, because they're just trying to take all of this money from these pension funds and these life insurance companies and get them into the real estate market. So they're just looking for vehicles that they can deploy money into fastest. So, you know, typically speaking, you know, just as we're talking about institutional investors, it's like, you know, 50 million is kind of like the starting point. Like you have to be able to deploy $50 million to start talking to, you know, private equity, real estate funds, et cetera. But the next, you know, moving down the line here, family offices are kind of that, like, you know, that's that happy medium, that Goldilocks group where, you know, many of them have, you know, and for those not familiar with the term family offices are usually, you know, an office that's been formed by a very wealthy individual, you know, typically someone that's worth, you know, 200, 300 million or more. So oftentimes it's, you know, obviously into the billions. We have more and more billionaires by the day. And so these offices invest on behalf of the family, but they're infinitely flexible because they don't have to, you know, they're not raising their money from institutions. It's their own money. But many times they can write, you know, 10, 20, $30 million checks. And so, you know, that is a group that we'll talk about here a little bit more in a minute, but, you know, is highly desirable, but very hard to get in front of and very hard to build relationships with. Then you have, you know, what is known as more, you know, institutional investors, which, you know, typically you think of as the private equity real estate fund. So, you know, these are groups that raise from, again, pension funds, sovereign wealth funds, life insurance companies, college endowments, and, you know, relatively conservative investors. They take that money and then they invest it into real estate on their behalf, oftentimes through joint ventures with smaller operators. So these folks raise these large funds, usually 500 million to, you know, 4 or 5 billion, and then they deploy it through smaller operators. So they find operators that have strong track records in an asset class in a geography that they like, and then they'll slice them off 50, 70, $100 million checks to say, all right, go invest this money on our behalf. So, you know, go ahead, Lauren. I saw your
You saw. Okay, I was going to wait, but my question is on the institutional side. You said they want to be able to deploy at least $50 million. Over what period of time? What would be the expectation? If they commit 50 million, how quickly do they want to see that deployed?
Sure, usually in a year. So, you know, they're typically looking at strategies where, you know, if you raise, just so everyone gets a sense of like how these, like, you know, funds work. You know, let's say they raise $500 million. They need to, you know, the business plan is they need to get that money out. They need to invest it. It needs to, you know, if it's investing into value add or opportunistic projects, you need to be able to execute on the business plan, stabilize it, sell it, and then give the money back to investors. And these business plans are typically 5 to 7 years. So when they raise a $500 million fund, they have to get that $500 million out pretty quickly. Like they need to get it out in the first, you know, few years, which is why they need to find as few vehicles as possible that they can pump that money through. So they don't want to be writing, you know, they don't want to find 10 different sponsors or 10 different owner operators to, that can each put out 10 million bucks a year. They want to find 2 or 3 that are able to put out 100 million bucks a year. And if they've raised a $5 billion fund, now they can only write $500 million checks. Like they can't afford to do 50 or $100 million checks. So that's like, Blackstone and Starwood, et cetera. Like you need to be able to put out, hundreds of millions of dollars, which is, only for the largest owner operators. Did that answer your question, Lauren? So when we talk about private equity real estate, again, 50 is kind of the sweet spot, 50 and up. We can get down to 20, but these folks are highly, highly sophisticated. They are, professional real estate investors that have already raised this money. So again, they're just looking for boots on the ground. So when we're thinking about approaching them, our value proposition to them is that we're boots on the ground. We have relationships. We've got a pipeline that they don't have. And they are not passive investors, though. They're going to give us 50 or $100 million, and then they're going to become our bosses, and they are going to sit behind us. Ideally, they're bosses that are really smart and fun to work with, that are going to make us better. But know that there is a ton of control that falls on your back once you take money from these folks. And so then we've got institutions, who are the folks that they typically don't invest directly into real estate. They invest through these different private equity real estate models. And we've got venture capital, who is kind of a newer player in the real estate capital markets. Not someone that I typically recommend people raise money from because their growth expectations are too high. But they are a newer player for super high growth strategies where they think they can like 10x their money. So an example like that is someone like, I know someone that just raised money from venture capital to go do this campground strategy where they're buying land. There's a big arbitrage play to go buy land, in these beautiful places, but it's just farmland, and then turn those into like, off the grid camping escapes. So it's like super niche, super nuanced stuff that it will attract some venture capital, but typically not something that we're going to talk about, especially from an institutional perspective. So going through some of these folks, I want to give everybody a good understanding of who these players are. So we're not going to spend a ton of time on the high net worth investor, but because I think most of you are relatively familiar with this persona, but for the most part, this is somebody that is very flexible. They're comparing this to multiple different investment opportunities, and they're really they're going to pay the best fees. They're going to be hands off, and they're going to be one of many investors. So we're not going to have a lot of reporting responsibilities like we're going to have if we take $50 million from a private equity real estate fund. The next one is Fred. So, again, I want to make sure everyone knows, each of these characters. So, typically at a family office, you have a chief investment officer who is going to be responsible for investing, the family's money, and they're building a portfolio. So, call it like 10 to 20% is typically going to be allocated for real estate. So Fred is going to be looking for a few platforms that he really likes to be able to, act as the family's, real estate allocation. So, typically speaking, Fred can, invest checks from $2 to $20 million. In this case, this is pulled off of a case study where he's looking for value add and distressed deals that, he's not just looking for, IRRs. He's looking for, long-term cash flow. A lot of times family offices like investing in real estate because it's a hedge against inflation, which means, rent growth is growing faster than inflation, and then the properties are appreciating faster than inflation. So they feel very comfortable placing money into, a cash flowing multifamily building for sometimes 20, 30, 50 years, if it's going to continue to beat inflation. So very different from, your private equity real estate fund that writes you a $20 million check. They're going to need the money back very quickly, and they're going to want to see strong returns because they need to pass those back to their LPs. Whereas family offices can be much more flexible. They can hold for very long time periods. So if you are doing something that, needs some seasoning and needs kind of 10 years to fully realize its business plan, and you need access to very large checks, family offices are going to be ideal. The challenge with family offices, though, is the joke in the industry is if you've met one family office, you've met one family office, meaning that they all operate differently. Like there's no formula for family offices. They all have different incentives. different structures. Kids have different motivations. Where you are generationally down the line really changes how they think about their investing behaviors. So it's a very hard demographic to like pin down and put a strategy together for. So it really is kind of a one by one rifle shot approach, to connecting with these folks. And it takes a long time because they usually typically pick one or two groups that they want to invest with and a strategy they want to invest with. And then they go all in and they get a ton of conviction and they'll invest with you for 20 years. So they're an unbelievable relationship once you can get it, but not an easy, unlike private equity real estate firms who can structure a deal with you because the money's already been raised and they know the strategy, they can put a deal together in a month or two. Like family offices typically take a year or more to really build that relationship. So just some family office examples so we're clear on what they are. There's, groups like Iconic, who are a multifamily office, which is more like a registered investment advisor, and kind of in some ways like a private equity real estate fund where they invest on behalf of multiple families. So they do not have like solo decision making, but they have a lot more money and they're a dedicated real estate arm for lots of other families. So Iconic is an example of a group like that. Rowan is an example of a very large family office that has a dedicated real estate arm. So they behave more like a private equity real estate firm where, they have a dedicated team that just focuses on real estate and investing in real estate on behalf of the family. And then we have, what is 95% of the market, which are these smaller family offices that are more generalists that have somebody like Fred, who is the chief investment officer, who's looking at real estate, but also looking at, public equities and, private equity and a million other investment opportunities alongside real estate deals. So again, one day he may be really focused on a real estate strategy, but then he may be spending all of his time looking at investing in an art marketplace. So, really hard, there's tons of, there's over 10,000 of these, Jackson Hole capitals that exist out there today. But they're just very hard to pin down and their, mandates are kind of always moving based on, what they're interested in the market at any given time. So then, we've got Ralph, who is our private equity real estate investor. This is typically who we're thinking about when we're talking about institutional investors. So, in this case, he just raised a 600 million closed-end fund. He's looking at, investing somewhere between 30 and 300 million into different strategies. And, ideally that's, he's looking at things that can be invested in, that one, in a 1 year time frame where he can get money out the door. He's looking at joint ventures again, and we can dive more into joint ventures if that's where we want to spend our time today. But joint ventures are typically structured, where there's fee sharing between Ralph and the owner operator. So yes, Ralph is slicing us off 50 or $100 million to go invest on his behalf. But he's already getting his like 2 and 20 fees from his LPs. So he's basically sharing those with us. So, we might be getting, a half a point or 1%, and then he's keeping the other 1% on the asset management side. And then, we are sharing, the 20% or the profit share. And, we can talk more about how those deals get structured. But, that's why he's able to give us money much faster, is because he's already raised it and it's already been earmarked for certain strategies. He's just looking for the right strategy to, basically wire the check into. But, again, he's looking to structure joint ventures. He's looking at value add and opportunistic strategies, typically, targeting mid-teens to high teens IRRs, and typically targeting, at least in this, in this market, 7% plus unlevered yields, just because, again, he needs to find deals where he can, apply leverage. But, Ralph has been doing this for a very long time. He's highly sophisticated, especially with financial engineering. So he's going to have significant control over investments. So when you take $50 million from Ralph, you need to expect that, all acquisition decisions are going to be run through Ralph. All financing decisions, especially if you're like refinancing a portfolio or doing something like that, Ralph is going to have final say. Disposition of properties, Ralph is going to have final say. So Ralph is going to have significant control. Ralph is going to be looking for us to do kind of like the boots on the ground work on his behalf. But he's going to make the ultimate decisions. He's going to kind of be the CEO of this joint venture. Someone that's worth noting is Hazel, who's our hedge fund investor. So hedge funds are also a type of private equity real estate fund. They do invest in real estate. They'll usually call it infrastructure or real assets. And the difference between Hazel and Ralph is that Hazel is very much focused on using like even more creative with using leverage and even more willing to go into like super esoteric stuff. Like hedge funds, I always see going into like stuff like Top Golf and stuff like wind farms and like usually something that has like a heavily operational component to it that looks more like a private equity deal and can layer on debt into like the operating company and the property company. They typically like really funky stuff because the hairier the deals, the more creative they can get with different financing structures. But otherwise she's going to be pretty similar to Ralph in that she's going to have a lot of control. She's going to control all major decisions, and she's going to be sharing her fees with us. So again, it's not a pure like GP LP relationship. It's more of a partnership where we are sharing in the fees of Hazel's LPs or of Ralph's LPs. So just talking about some private equity real estate examples, so everyone has kind of a working knowledge of like these folks in the wild. So Blackstone, you're all probably familiar with Blackstone. It's a very large private equity real estate fund. They've got funds for lots of different strategies. They'll have Blackstone Industrial Fund 12, Blackstone Hospitality Fund 3, and these are massive funds that they raise around specific asset classes. Then you have a group like Palatine, which is more of like a mid-sized private equity real estate fund. These guys just raised a $700 million fund. They're probably more similar to Ralph, and they it's not for any one thing. They probably have 3 or 4 asset classes that they're interested in, and they're looking for joint ventures with owner operators in those asset classes in those geographies. Castle Lake is an example of a hedge fund that has a real assets component to it that will look at super esoteric deals. Milestone is a co-GP fund. This has become more and more relevant in today's world. So, as many of you are familiar, you'll have a co-investment as a GP. Depending on how much LP money is going in, you usually have to come up with $10 million. So, if we do a deal with Ralph for $100 million, we're probably going to have to invest 10 million ourselves. And if we don't have 10 million liquid, we're going to have to go to another fund to get that money. So co-GP funds have emerged to provide, the GPs with their piece of the capital that they need to invest alongside, larger LPs. Platform investors, which we can talk about here in a second, they invest not just into the assets, but oftentimes into the company. So if you need working capital, if you need, pursuit costs for deals, et cetera, they can finance like your operating company, your holdco, alongside the real estate that you're trying to finance as well. So, there's more and more of these groups that are growing because they can find, better and better returns when they can invest across like, in multiple entities. So, that's something that if you're looking for, if you've got track record, but you have working capital needs, you need to hire more people, you need to, grow another office in another market alongside actually have capital to buy the buildings. Platform investors are a great option. And then the last one here is Cloudland, which I'll mention, which are seed investors. These are more and more relevant as we're seeing more emerging models that need access to capital sooner, access to large amounts of capital sooner, and don't want to go through 5 years of raising on a deal by deal basis. There are groups that will invest at an earlier stage, but they'll just be a much more aggressive with fees. They'll take a piece of your GP in perpetuity, kind of like an equity investment. And what's important to know about them is that they can write you a $10 million check or a $20 million check earlier than you would otherwise get it. But they're typically looking for super innovative things that are, could be category winners. So that might be something in like electronic vehicle infrastructure, which is popular right now. Some other outdoor hospitality concepts that, could grow very quickly, et cetera. But I'm conscious that we're already 30 minutes in. So let me take a pause, and Lauren or Eric, if there's anything you want me to dive a little deeper on, but happy to just start taking some questions and then maybe organically talking about, best ways of, presenting and getting in front of these folks, based on what we've discussed thus far.
Does anybody have any questions for Paul at this point? I mean, the amount of information so far in this hour has really blown my mind. And Paul, thank you so much for providing this great info for us. Does anybody have any questions?
Um,
Have there been any deal breakers where you just won't work with a certain private equity fund or institutional investor?
Yeah, so a good question, Christina. And it's when you're running this process, I'll kind of tie this into a bigger theme. It's really important when you go through raising institutional capital that you create a competitive process. You want multiple groups who are bidding on this because, as discussed, if only Ralph and one Ralph is interested in investing in your deal, you kind of have to take whatever deal they offer, and they're going to take so much control. They're going to crush you on fees. Like they're really, I mean, this is their, these are private equity real estate people. They are ruthless. Like, they're sitting in Midtown Manhattan. They're ruthless. They're not necessarily bad people or anything like that, but they are fully focused on their own financial return. So, if they see an opportunity to take from you, they will. And so that, it's really important to be creating a competitive process so that you can weed out those folks. I mean, there's plenty of people, a lot of it's matchmaking, like it's dating, like it's how well do we get together because we're going to have to be working together for the next 5 years. So it's really like a cultural fit. And if it's someone that you're just like, this man or woman is an asshole and I can't deal with them, and they're just, it's like having a bad boss. So, that's kind of the deal breaker more than anything else. I mean, obviously terms of a joint venture with a private equity real estate shop will, dictate whether or not a deal gets done, or, if they want to be too aggressive on fees or they want to be too aggressive with control. You're probably going to say no. But then after that, it's like, the softer touch of like, how well am I going to get along with this person for the next 5 years?
Feel free. Anybody else, if you have any questions for Paul. Christina, that was a great question. I was also actually wondering that question myself too, because again, relationships are everything in real estate. Does anybody else have any questions?
Yeah, I'd like to talk, Paul, if you could talk a little bit about approaching. One of the things I loved about your class was you got very, very granular about even how to approach some of these companies. And so if you could talk a little bit about that process, that'd be great.
Yeah, so let's go here. Uh, let's go here. So, something that is, I mentioned it's very formulaic in approaching these groups. So, a big piece of the formula when you're approaching private equity real estate investors is making sure that your unlevered yield, as discussed, is attractive enough for them. So again, if there's one thing you take away, it's, really understanding that, when you're pitching these folks, the unlevered yield has to be, 100 basis points or more above wherever interest rates are today. So that's kind of day one. But that's really just the strategy, right? That's forward looking. That's saying, hey, I'm going to execute on this. I'm going to do X, Y, and Z, and then I'm going to hit this unlevered yield. And anybody can make it on, it's just math. So anybody can make an unlevered yield look attractive. What these folks are really going to care about first is track record. Track record is so important with these folks. You could have the greatest idea in the world and it can make all the sense and they can understand there's, huge demand tailwinds for this. But if you can't point to them and show them that you've been doing this for 5 years, for 6 years, for 7 years, and track record means buying properties, doing whatever you say you're going to do to them, that's, the same as what you're pitching them on the go forward strategy, and then being able to, stabilize those properties and sell them and hit the returns that you promise, it's almost a non-starter for them. So it's very, 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 very rare that they will ever invest in anyone that doesn't have track record. So track record is the number one most important thing. And it's a very frustrating thing for so many sponsors, especially really smart, hungry, entrepreneurial people who are like, I have this massive idea. I just need access to 20 or $50 million. And I'm smart and I've studied the space, They don't care because ultimately at the end of the day, they have to report back to Harvard's endowment fund. They need to report back to the California pension fund, and they're not going to lose their jobs or they're not going to stop raising money if they can point to somebody and say, look, this person had done it 50 times before. It was just pouring gasoline on the fire versus we took a flyer on somebody that we thought was a really good idea, but they had no track record. So overdoing it with track record, but like that is probably the most important thing that you need to be able to demonstrate to these investors. Number two that you need to be able to demonstrate is your ability to deploy capital at scale. So that's just understanding that, you can deploy whatever they need deployed, $50, $100 million a year. And so that's going to be in the form of a pipeline. So you show that by saying, look, these are the 50 deals that I'm currently looking at. The total capital that I need for this is, 200 million in equity. And you show that, it's not just something that you've like pulled off the MLS or like pulled off, CoStar or something. It's, deals that you can articulate that you're in active conversations with the brokers or in active conversations with the sellers about acquiring these properties. So that's number two. Number three, that's super important here is downside protection. You have to be able to articulate the downside protection here. As you all know, that's why people like real estate, is because there is, in some cases, meaningful upside, but typically you're not going to lose your money because you're investing in, a tangible asset. So that's why private equity real estate exists, is for that, that strategy is, and so they always look at, unlike a venture investor that's looking for infinite upside, when you're pitching institutional investors, you're pitching downside first. So you're always explaining to them with your underwriting, with your story, worst case scenario, this is what happens, like, if this doesn't go right. Like, if we don't hit the rents we think we're going to hit, if we don't stabilize the property we think we're going to do, or construction takes longer, or whatever it is, you're still going to at least get your money back plus some return. So, whereas most people, when they think about business plans, they think about raising a lot of money. They're trying to tell the investor how they're going to make millions and billions of dollars. In this case, we're telling the narrative that we're telling people is how we're not going to lose money, and then, how we're going to make the money. So, that's always something that we want to keep in mind, is super conservative. So like, this is pulled directly out of KKR's real estate fundraising deck, and, differentiated conservative investments. Like, that's what this market wants to hear, is it's differentiated, it's different from what other people are doing, but it's conservative at the end of the day. Downside is protected. So that's number three. Number four is competitive moat. If you need to be able to explain to people, especially when you're dealing with institutions, they're dating everybody, and they're the most, everyone is looking for money from them. And so they have their kind of pick of the litter. So they're going to pick someone that they know has some type of competitive moat, whether that's they know a geography better, they know an asset class better, et cetera. And then lastly is growth ambitions. When you're raising on a deal by deal basis, you're really just talking about that deal. Institutional investors want to know how you're planning to grow over time, so that they can continue to partner with you. So they don't just want to hear that you're going to continue to stay the same size. They want to know that you as an entrepreneur are looking to scale this platform over time, and they're going to be able to continue investing with you, over the next 10 years.
Hey, Paul, I have a question. But before I ask this question, I'd like everyone to turn on their cameras and take a quick picture.
Picture time.
A screenshot. Here we go. All right. Everyone turn the cameras on, no matter where you are. Okay, here we go. In 5, 4, 3, 2, and 1. Awesome. Awesome, Paul.
Thank you.
Thank you so much. Hey, Paul, I wanted to ask you a question. You've given us so much information. One of the things that I'm thinking about is, number one, to learn more about you. How did you initially start it with this? Did you start off really raising capital with individuals and somehow stumbled upon institutional? That's my first question. And then second question is, why did you start the thesis educational platform? So if you can answer those two questions.
Of course. Yeah, no, from an institutional capital standpoint, I didn't come from the investment banking world. I came from more of the traditional real estate world, and I worked at a company for a long time, where we went from raising, we started out with family offices. We raised money from, a couple family offices, and then we evolved into, we ultimately put together a joint venture with Blackstone. And so I saw, kind of the power of structuring joint ventures. And, I started, the real reason I started PTB was I was seeing a lot of different innovative real estate companies that were looking to, partner with institutional investors, that maybe had some tech component to them, or were, coming out of new asset classes. And I just saw white space, as an entrepreneur in that space, to help those types of, sponsors and operators, again, in these like nichier asset classes, access, larger capital at scale, and really just help them, frame themselves and position themselves. Because I know what it went through to, position yourself for a partnership with Blackstone. I knew what they wanted to see. And again, it's relatively formulaic. And, if we're being honest, like, it's a lot easier to structure $100 million deal with a private equity real estate fund and get paid, my business is commission based, right? So I get paid 2 to 3% on whatever money I raise. So I can go try and raise 50,000 or 100,000 or $250,000 checks from lots of people, or I can structure one deal between a big private equity real estate firm and, a sponsor, and, make more money doing that. So, for me, it was, kind of commonsensical from a business model standpoint to go the institutional route. And within that, I saw the reason you want to just jump into that is because like JLL and CBRE and Morgan Stanley, everyone already services that space. So I saw white space going into, some of these more niche asset classes that people weren't taking the time to understand, where I thought there was a lot of opportunity. So, that's kind of on the PTB side, why we started that, and, where we've been playing in that space. But then, thesis driven was more, again, I just saw so many opportunities. It's people need to be educated on how the real estate capital markets work so that they can understand, how to scale their businesses. And again, there's just nothing that exists out there other than like some snake oil salesman on Instagram that, can actually, explain the ecosystem to you, help you triangulate where you are today, and who you should be raising money from today, tomorrow, et cetera. And then give you the, the playbooks, like how does an investment bank run a process for, raising $100 or $200 million. And again, it's not rocket science. Like I'm laying it out for you right here. Like it's really just using these 5 tools and telling the right story around those 5 narratives or those 5 subsections. And then being able to get in front of these folks, which, is not rocket science either. But, without that knowledge, I think so much in real estate, people are purposely opaque in sharing information in real estate. It's so different from tech, where like everyone's out to like there's a community where people want to help each other and help each other grow, et cetera, et cetera. Real estate, I think, will change and turn into that. But that's something that I'm trying to push forward with education, with events, et cetera, through thesis driven.
Awesome. Thank you so much.
I have another quick question. So here we have KKR and their investment strategy is the top 20 MSAs. Who do you see investing in, say, the top 30, like some of the high growth Midwest areas like Kansas City, Indianapolis, Nashville? They're high growth in population, but they're not in the top 20.
Yeah, so great question. I think the real estate private equity community, the institutional real estate community, I don't know how to say this. Lemmings is the best way to describe, right? They all just follow each other into different theses. Like the last 18 months, build to rent strategies, buying land and building single family homes and renting them out in like Texas and across the Sun Belt is like where everybody wanted to be. And that has been like the theme. And so like, any type of Midwestern strategy, like if it wasn't like one of 4 things, like they weren't interested. And that's just kind of how the industry moves, is you kind of always have to know that at any given time, there's kind of like, 5 to 10 strategies that are a combination of the asset class and the geography that they're interested in, that they're all focused on, and they're all looking for like owner operators in those markets. And if you're not in there, like they just won't talk to you. So like Chicago for the last, 3 years has been like, you couldn't raise any institutional capital in Chicago, because everyone was like, Chicago's dead, blah, blah, blah. Now we're just starting to see like institutional capital trickle back into Chicago. And I would not be surprised if, this time next year, like there's a huge thesis around office in the Midwest. Like everybody wants office in the Midwest, which is like the least popular thing, or was the least popular thing, like middle of 24. So, as far as like those like outside MSAs that aren't like, top 20, that's typically where you want to be looking for family office money, especially family offices that are focused in those markets, because they're always going to want to be, invested in their backyards. So family offices are always, they're not institutional players, but a place you should look. Otherwise, it just really takes turning over a lot of different rocks. There's probably only like 400 private equity real estate funds in the US to reach out to. So, and 95% of them follow the exact same trends. There are the contrarians that try and be in like new markets first. But, it's really a function of just getting in front of enough people with your strategy, but then also educating them. Because, if they're not all lemmings, and if they do see something that's really compelling that you're working on, they can shift into your strategy if they, are properly educated.
Hi, this is Sean. Could you speak more to the mechanics of the co-GP investor, as far as funding, pursuit costs, or expanding to a new market, growing a company? That caught my attention. I was unaware of that being in existence. I tried to kind of recreate that in my own ecosystem of relationships. But can you speak more to that? How the criteria, cost, how that works?
Yeah. Totally. So, there's kind of two types of, capital for, that's not for assets, that is more for the operator. And, it's easy to get these terms mixed up. So, there's kind of like GP equity. Well, there's GP equity, GP debt, and then, co-GP investments. So, ideally, Sean, what you're looking for as an operator is debt, right? And there are, family offices, and there are private debt sources that you can access for working capital, to cover pursuit costs, to cover, any of the soft costs related to like architecture fees and, legal fees, et cetera, that, everyone's familiar with when you're, pursuing real estate deals. So debt, for obvious reasons, is the ideal form. There are groups, especially family offices, that will come in and provide GP equity for ownership in the GP. So they become your partner, but they're, financing all of your deal costs, et cetera, but then they're taking pieces of your fees. So they're taking pieces of your asset management fees, they're taking your development fees, they're taking acquisition fees, they're taking pieces of your promote. And typically those structures are like, rarely do you see them go like over 20%. They're usually taking somewhere between like 3 and 20% of the GP, depending on how early they're giving you money. If you're a brand new sponsor, but you're looking to scale up really quickly and you need a couple $1 million, they're going to take 20% of your company, kind of 20% of the, the hold co, if you will, or the GP. If you're, just kind of like, if you've been around for 20 years and you're just looking to expand into, a new market, and you need to pay for some salaries, but you just don't have the liquidity, and they want to do it in the form of equity, not debt. Then, it's probably more like, single digits or low single digits that they're looking to take from like, a GP perspective. Now, the other type of GP, equity, again, as I mentioned, is separate from that kind of working capital need. And that is, the co-investment piece. And again, you're seeing more and more of these GP funds emerge that are doing, GP co-invests, where, again, as you're getting into as a sponsor, bigger and bigger deals, but you need to put up $5, $10, $15 million yourself into, $150 million deal, then and you don't have that liquidity, then they will come in and provide you that co-investment liquidity. But they're not coming in, and that's not working capital. That's not, kind of any other strategic capital at the operator level. That's just purely your co-investment piece into, an asset or a portfolio.
Hey, Paul, I want to take these last few minutes. You mentioned so much about institutional capital raising, and your course, is that only for people who are interested in institutional capital raising? At what stage is the thesis-driven course good for people? In what stage of their capital raising journey?
Yeah, thanks for asking, Alex. It really is, it's probably easiest for me to say who takes the course. So there's really three profiles of people who typically take our course. One are sponsors who have been, typically raising, on a deal by deal basis, from high net worth individuals, accredited investors, et cetera, who are looking to access larger deals. So, really getting into, we break down in a lot more detail who these investors are, how they pay fees, how they think, how they work, and then how do you position yourself, and run a process to get in front of them. So that's kind of our primary, user or student, is folks that are moving from, high net worth deal by deal capital to trying to unlock larger checks. And again, it doesn't just have to be, quote unquote institutional. It can be family offices as well. We see that's kind of the transition stage for most groups, is, accessing family office and then moving on to institutional. So that's one. Number two are people who are, we happen to get a lot of tech entrepreneurs who have had big exits in tech, are now getting into real estate, have a big idea, and are realizing they don't understand the real estate capital markets because they're totally different from the tech capital market. So, we get a lot of really interesting tech entrepreneurs coming through, just trying to educate themselves so that they can put together smarter business plans on how to scale. And then the last type of person we get is typically someone who's maybe in acquisitions or who is in asset management, but who is realizing that from a career perspective, it'd be really helpful for them to become an expert on the institutional capital markets. Either that's because they want to, do what I'm doing and, place capital or place equity, or they, within their existing operating company, they want to be, the fundraising person within the company, which is going to allow them to, get a bigger bonus or get a bigger salary, or, whatever that is. So those are kind of the key types of people. So, the course really is focused on anyone that, is putting together a strategic business plan to grow their real estate platform. Because, it just blew my mind that there's so many people that have brilliant operating strategies that just don't have a capital strategy, and capital is what makes the whole thing move. But it's typically not for people who are like just starting out or just looking to do their first real estate deal, because it's information that candidly, like, you need to go do a couple deals before you can start thinking about, like, accessing capital from larger sources.
And if I could just take a second to say, I actually went to New York and took Paul's class, and it was really, really fantastic. I think all of us have taken courses that are really just, very high level and don't really get into the details. But I actually connected Paul with Alex and Eric because I was so impressed with his class. It was 2 days in New York, and the way he really got down to the tactical things you need to do. It really, because I've only raised from retail investors up to that point, it really helped me understand the whole ecosystem. So if you're interested in taking his course, I have no financial gain out of this. I just want to plug it for a second because it really was eye-opening. I highly recommend, if you do want to take the course, to do it in person, because the room, as he just described, the people in the room, I got just as much out of meeting them, and I got a lot of Zoom calls after it, were really, really high caliber, sophisticated people. So if you're interested, I would recommend doing it in person as opposed to online, so you can really get to know the other classmates, because they're really great people. All right, that's
awesome. Thank you, Lauren.
Yeah.
Awesome. Thank you so much.
Totally. Any last minute questions, Alex, or anything else you want to touch on?
I had a question
again.
Oh,
go ahead.
If I may, please.
Please.
Just curious to see your opinion of the fund-to-fund model for, more the retail investors, say a $1 to $5 million fund that we're running and deploying capital through other sponsor relationships, like kind of serving the same role as a PE fund or a family office, as you described, but on a smaller scale. What are your thoughts on the validity of that in today's market?
Yeah. I mean, listen, right. It is, in fact, as you said, Sean, it's the same model as what these private equity real estate funds do. So, to bet, if that's not that that's why you were bringing it up, but like, that's a good way to think about, who Ralph is someone who's just doing that. But Ralph's raising from pension funds that are writing him $100 million checks rather than individuals writing him, $100,000 or $200,000 checks. On the fund-to-fund model, I think there's a massive opportunity right now. And Lauren was awesome in our course because she could educate people better on raising retail capital than I can. I think there's a massive opportunity with the digital infrastructure that's now in place that as a fund of funds, if you can articulate, I think it's really important to educate people. So like from a retail investor perspective, I think any fund of funds that is able to educate and not just like sell people on like, 20% or 30% IRRs, but say, I'm really going to help you understand what you're investing in. And then I'm going to, share with you, some of these, nichier deals or, just articulate, the value add strategy. I mean, I always gravitate towards stuff that's more esoteric and more weird, because that's where I think you find the best returns. But if you can articulate, why you're focused on 2 or 3 really unique asset classes in new geographies and how, there's, growing demand for those. I think retail investors are a lot more commonsensical and a lot more narrative led, when you can explain very simply, like, this is why we're investing in, campgrounds in, Wyoming right now, and be able to educate them. I think there's a ton of opportunity to raise a lot of money online, by using, more traditional content marketing strategies and things like that. But again, most of you are on this call are more sophisticated than I am, around how to actually raise retail capital. But I would say that like taking a page out of the private equity real estate playbook and really getting smart on 3 to 4 asset classes and geographies you like, and then being able to articulate them and market them to folks and educate people on them, I think there's massive opportunity in that.
Thanks, Paul.
I've got a question,
Mhm.
Paul. Really appreciate your time. As I said up front, thank you so much. If we're gonna go raise capital at this level, these type of organizations, is it necessary to be some type of registered broker dealer or the like, to have the credentials? What do you say to that?
Don't need to be a registered broker dealer to raise money from private equity real estate funds. I mean, that's purely just a joint venture agreement. If you were structuring them, you do. Like I'm registered, because I'm the one that's acting as the intermediary. But if you are an owner operator that's connecting with these groups, you don't need to have like, broker dealer license, a registered RIA. Like you don't need any of that. But if you are getting into actually being an intermediary and putting institutional capital deals together, or recommending investments, to institutional investors, then yeah, you need to be, registered with like, Series 63, Series 7, all of that stuff, and run everything through a broker dealer.
All goes back to track record, right?
Exactly. All goes back to track record.
Thank you.
Any other questions for Paul? Paul, thank you so much for all the info. And please, how can people get a hold of you? I know Lauren was nice enough to put the next class that you're offering, which is March 18th and 19th. But if somebody would like to get a hold of you for future information, please put your info in the chat, because I know that we're going to have plenty of people that will take advantage of that in this group.
Totally, yeah. Feel free to just email me at my email, pstanton@ptbankers.com. And just give me a couple days to get back. So if I don't respond immediately, I'm not ignoring. Just know that it'll it might take me 3 or 4 days. But yeah, happy to talk to anybody further, and excited to hear questions. And yeah, look forward to continuing this, and can't thank you all enough for having me. This was awesome.
Well, thank you
so
for
much.
being our guest today. It's been
All
great.
right.
We appreciate your time.
Appreciate your time,
Awesome.
Paul. Have a great day.
Thanks, everybody.
you.
Have a great weekend.
Take care, everyone. Bye-bye.
That's a wrap for today's 911 real estate call.
Thank you so much for attending, sharing your thoughts, and learning with us today.
Real estate isn't just about numbers. It's about creating intentional moves and finding opportunities that align with your goals.
Whether you're saving lives, leading a business, or growing your investments, the goal is to make your money work for you.
Stay engaged, keep learning. Let's keep pushing forward towards financial freedom.
We look forward to seeing you on our next call.
Until then, stay focused,
Stay connected and keep building wealth.
one property at a time.